Well, finally, a bit of good news to report on the interest rate front. So we're going to dive right in and look at some numbers. Today is Thursday, the 20th of February. I hope you are doing well. I hope you're staying warm. It is a cold one today. All right, let's dive right into the numbers. According to Mortgage News Daily, 30-year fixed rate conforming loan, 6.96 today, y'all. That matches the lowest that we have seen over the last 30 days. 1 week ago, we were sitting at 7.04 in that same survey. A month ago, we were at 7.08. So we're seeing a bit of a trend line lower over the last few trading sessions after a fairly rocky 30-day period in interest rates. And here's what's moving the market, y'all. The Federal Reserve actually helped us. We just received the minutes from their last meeting. And going through those minutes, the Fed said something that was unexpected. They mentioned that the runoff of their balance sheet, the speed at which they are allowing fixed income securities to fall off of their $8 trillion balance that they currently hold. You heard me right on that number. They are planning on stopping that runoff mid-year. Y'all, to accomplish that, they have to repurchase some bonds or at least sell them back into treasuries in order to stop the flow of those into the marketplace. Keep in mind that bonds are just like anything else in the economy. When you have a bunch of them for sale, that pushes the price down and the yields move inverse to that price. So when you have a declaration from the Fed that the supply is going to be limited below what the market was anticipating, and by mid-year, which is right around the corner, well, then that helps bonds with that supply-demand equation. The assumption now, there's going to be less debt instruments on the marketplace. That'll push prices up a little bit. That should push yields down some. So that's why we're seeing a bit of relief today. Y'all, the consumer price index that came out stronger than expected this last week gave us a much higher pop in inflation than the market was anticipating. The Fed minutes also verified that they really aren't that concerned about a January CPI read. That a lot of companies reset pricing for the coming year, and that it's not uncommon to have a high read on inflation for the January numbers. Now, if that starts a trend, that's a different issue. But the fact that it was the first CPI read of a new year, the Fed members really had comments that just discounted it for that reason. What does this mean for Fed cuts in the future? Well, y'all, on our call last week, we talked about the fact that the CME FedWatch tool, based on Fed futures trading, didn't see a Fed cut until the September meeting. They're now pricing in a 53% chance of a Fed cut by the July meeting. So we've moved up the schedule of that anticipated quarter or higher cut from September to July, just based on these today reads on the Fed comments that we've just received. There's also quite a bit of discussion, y'all, and this was not so much in the Fed minutes, but there's a lot of speculation among the folks that live in this space that I read and rely on. At what point are these federal reductions in workforce going to start being revealed in the unemployment rate? Remember that a 4.5% unemployment rate would surprise all 19 voting members of the Fed. So if there is starting to be the notion out there that we're going to see such significant cutting in the federal workforce that it's going to push the employment rate higher, then that could change the pace and the size of future Fed cuts as well. I think we're starting to see some of that work its way through the market. And one other piece of speculation that's frankly just from me that I'm throwing into this, we are starting to see more and more people on both sides of the aisle getting on board with eliminating massive government waste. With DOGE and with all that they are doing and identifying as far as low-hanging fruit, which may lead to a need for less borrowing in the future to finance a massive deficit that maybe there's a little more tolerance to start shrinking. And if that proves true, y'all, that's also going to paint a much better picture for the debt load of our country, and that should bring interest rates down as well. So it's a mixed bag, folks. There are so many competing economic components out there that can move the needle either way. All we can do is stay on top of it, look at it week after week, and see what the trend lines are and where it might be headed. Hope this is helpful for you and for your clients. As always, you have all of my contact information on the screen. Be blessed, stay safe, and we will talk to you next week.